stock market just got clobbered today, led by tech, as the Nasdaq closed about 5% down, the S&P 500 closed about 3.5% down, and the Dow Jones closed a little bit under 3% down. So with what appeared to be a strong rally over the last couple of weeks, paired with my recent projection that the S&P 500 would reach 3,800 by the election. Number one, what caused the sell-off today? And number two, does this change my thoughts at all about markets or my projections going forward? Let's dive in. Hindsight is 2020, right? So obviously anybody can always look back at, after the fact, after something has happened and say, hey, this happened and right before it, X, Y, and Z happened. So causation, right? So obviously it's much easier to make a case after the fact as to why something happened rather than saying, hey, these things are going to make something happen in the future, right? One of those is much easier to do than the other. And so I get that. But there were a couple of things that would lead somebody to say, hey, there's probably going to be a sell-off soon because of these reasons that were, have been happening over the last couple of weeks leading up until today. One of those things is the VIX. Now, the VIX yesterday and prior to yesterday has been basically at all-time highs while the stock market has been making all-time highs. So what that means is that yes, there have been times when the VIX has been higher, but on days where the stock market is making all-time highs, yesterday and the couple days leading up to today, the VIX has been at its highest point while the S&P 500 has been making its all-time highs. Now, if you don't know what the VIX is an index that measures volatility expectations in the stock market. And what this means then is that the expectations of volatility in the stock market have been at their highest while the stock market has been at its all-time highs. Normally, when markets are making all-time highs, volatility expectations are a lot lower than they were over the last couple of days leading up to today. Now, you might ask, what does the VIX mean? How are these volatility expectations calculated? Well, I'm glad you asked. These volatility expectations are calculated using options on the S&P 500 because when you think about it, an option price is what a seller of that option is willing to sell that option at in order to compensate themselves for the risk of losing money. And an option seller will lose money if the option goes further in the money than what they brought in on the premium to sell that option. And so the overall, when you take all of the options prices, you gauge what the market, all the supply and demand, all of the buyers and sellers, what the market expects the price movement, the average volatility will be in the market. And so that's how the VIX is calculated. It just basically is looking at the price of options to determine what the market expects the volatility will be, because sellers of options are going to want to compensate themselves for the risk that they believe is there, that they will have to, that the option will that they'll lose on it. So when you look at the VIX, then you're looking at a direct market expectation of how much the market might move, which means, going back to my first point, that the market expected, even though the market was at all-time highs, the options pricing was pricing in a much higher volatility amount than normal when markets are going up like it had been. But the VIX was not going up in a normal fashion. In fact, the put to call ratio was one of the lowest that it's been in a very long time. If you're not familiar with the put to call ratio, it's basically just the amount of puts versus the amount of calls that are trading or open at any given time. And a low put to call ratio means that there's a much higher volume in calls than in puts. It's a bullish. That means that at that moment, more traders are expecting the market to go up than down. There's more calls being traded than puts. And so a lot of times is used as a contrarian indicator saying, hey, people are going to be wrong about this. And so, when the put to call ratio is really low, that means there's too much money betting on the stock market going up. And so the contrarian indicator would say, because there's too much money betting on the stock market going up, the stock market is about to go down. And so that's the situation that we arrived in here. The VIX, which is comprised of options prices, was high, but it wasn't an even mix of puts and calls like it normally is on average. Instead, it was leaning much more heavily to the bullish side. And if you haven't watched my delta hedging video, I'd encourage you to go back and watch that, because that explains the mechanics of how a massive amount of money coming in to buy calls can actually push the price of the underlying, the equities, the stocks up themselves, because of what market makers have to do to hedge themselves when they sell those options. But essentially, all you really need to know is that options pricing was increasing to a much higher amount than it normally does when markets are going up, and that was pushing the volatility expectations higher compared to normal during periods when the market is making all-time highs. But it wasn't because people were betting on a collapse. It was actually the opposite. Too many people were betting on it continuing to go up. Now, as any trend reverses, when a trend reverses, when it's based on incorrect assumptions about the near-term future, then the reversal of that trend is going to be drastic and severe. And that's exactly what we saw here. We've seen a decent, strong rally in stocks and in the markets over the last couple of days, couple of weeks. And so the reversal of that, since that was due to a little bit of too much of a strong rally with no healthy pullbacks, no healthy selling, all the selling kind of starts to happen at once, and the pullback all happens all together. Now, with that pullback, you see that we've basically retraced, not completely with the S&P 500, but we've retraced a lot of the gains from the last couple of trading sessions especially. And so this is a normal thing that happens actually when assets make new highs. Usually they have a rally and then they come back down to retest what was the level that was the previous old highs. And so this is a normal thing that happens in price action of gold or stocks or any assets. Anytime prices make new highs, you would normally see a rally and then a retest. And if it holds above the old highs, it kind of then establishes a new floor, and then it resumes a really strong rally from there. Now, the main stocks that were dragging the market down today were obviously tech stocks, led by stocks like Apple, which ironically have been the ones that have kind of been leading the rally up. And so they've been forming a little bit of what some people are calling a bubble, simply because valuations are literally at all-time highs, and many stocks are valued at higher valuations they've ever been valued at, even during the dot-com bubble. And so since they led on the way up, it makes sense that they would lead on the way down. All right, I can't believe I did this, but like an idiot, I'm editing my video right now that you're watching, and I realized I forgot to put in two major reasons that I wanted to talk about what led the stock market to sell off today. I'll throw pictures up on the screen. The first one is RSI, Relative Strength Index, and you can see that every single time this indicator shows these levels they're between 30 and 70, and every time the S&P 500 rallies to a point which pushes this indicator up past 70, especially to this extent, you usually see at least a little bit of a sell-off. And so this was one more indicator that was showing, hey, this rally is a little bit overextended, due for a little bit of a pullback. Now, the second thing that I forgot to put in the initial recording of the video is the Fear and Greed Index. And if you follow me on Twitter, you saw me talking about this earlier this week as well. But the Fear and Greed Index got up to a level at which it was pretty high. Now, it gets over this level more than frequently, but whenever it gets, this is a pretty high level here. Got to 77, 78 right in there. And So whenever it gets up to this level, this is considered like a contrarian indicator, kind of like the put to call ratio. And so when there's lots of greed in the market, then that's considered a time where it's kind of at the end of its, whatever point of the rally it's at. It would be considered a contrarian indicator that would be turning around. And opposite as well, you can see that at the bottom in March, fear was at its greatest there. And that's kind of when the bottom happened. And so that would have, again, as a contrarian indicator, when there was the most fear, that was the best time to get back into the market. So this was just the two more things that were indications that there would be some sort of a short-term, at least pullback in the market, that the rally was a little bit overextended and overdue for kind of a readjustment or correction, if you will. And so those are the two things that I want to throw in there for you. And that fear greed ratio is something that I'll link it in the description below. But they calculate that using things like the put to call ratio and using things like interest in bond purchases, and so there's like 7 different indicators that they use in order to calculate this sentiment indicator here. So those are 2 I want to throw in there. So sorry for the weird cut and background here, but I wanted to make sure I got those in there for you. Now, does this change my target, my projection, at least for stocks, for the stock market, the S&P 500 by the election? No, it does not. In fact, it actually makes me just a tad bit more confident with that price projection, because this pullback and this sell-off happened right now instead of in a month or in a month and a half. And so since this is happening right now, I would expect to see us establish a new base above 3,400, and after maybe a couple of weeks, continue to extend and see a big rally. And again, if you're new to the channel, I say this on almost all my videos. Before you comment about being perma bull or these price projections or anything about how stocks are really dangerous right now, go back and watch some of my old videos. Just because I think the stock market will continue to go high doesn't mean I think that's healthy for the economy, doesn't mean I think the economy isn't crumbling. These are not good indicators of the economy overall or of wealth overall or GDP or anything like that. These are simply reflections. Asset bubbles and melt-ups are reflections of currencies starting to collapse. And so I don't think that this is just a sign that we're pulling out of recession and all is good ahead of us and everything looks hunky-dory and it's watermelons and butterflies and rainbows and unicorns. So I don't think that, but it does look like this pullback would result in producing a new floor above that $3,400 level for the S&P 500. Stocks to kind of settle out here before the rest of the rally resumes. But what do you think? Let me know your thoughts and questions in the comments section below. As always, I really appreciate it. Hit that like button and that subscribe button if you enjoyed the video. It really does help the channel out. You guys have a great day.